Okay, so go ahead and set this up. Am I missing something? Okay. Slideshow from current slide. Oh, okay, well it's not showing slideshow on my screen, so let me close this and open it again. Okay, there we go. I have to make sure it shows properly on this screen, otherwise it won't show right when you watch the video. So, okay, so chapter 15, we're going to be dealing with leases. Okay, what happens? Companies will lease property, will lease equipment, and they'll do this obviously when they don't plan to purchase the item outright. So it's almost like what? They're renting this property, right? Okay. Now, what used to happen a long time ago is that companies would enter into a lease agreement to avoid having to show that they were purchasing an asset subject to financing. Okay. Now, why would they do this? They would not want to have to show this huge liability on their financial statements if they're assuming a mortgage or something for a building. So let's say they're buying a building for $10 million, they put $2 million down, all of a sudden they're having to put, what, an $8 million mortgage liability on their financial statements, and analysts get a little squeamish about a company who's all of a sudden putting down this huge liability on their financial reports. So what companies would do in order to get away from this notion of having to put this big liability, they would say, okay, we're not buying the property from you, we're just leasing the property from you, we're just renting it. So all they would have to do is show what? Rent expense, say, at the end of each year, and not have to show this liability. Now, of course, they wanted to purchase the asset, so what they would do is they'd put some sort of agreement into the lease, some sort of terms into the lease agreement that said something like the asset will revert to the leasee at the end of the lease agreement, because they actually did want to purchase it, right? So FASB, the Financial Accounting Standards Board, looked at that some years back and said, you know what? That's not appropriate. That is off-balance sheet financing. We aren't going to allow you to do that. If you meet certain requirements, we're going to make you count for that as though you were actually purchasing that asset. Okay? So what we're going to see is that when we meet certain requirements, we're going to have to account for something as a capital lease, meaning we are, they used to call it capital lease, now it's called a financing lease, and we're literally going to have to show as though we have purchased that asset. Now, of course, if I'm purchasing something, is somebody else selling something? So the lessor, the person who is leasing this property to the leasee, would be able to count for a sale at that point. Okay, and so we're going to look at it from both sides. Now, there are times where we are simply leasing property. That's called an operating lease, and that's going to be very easy for us. It's just like rent expense each period. Okay, so everyone understands what a lease is, right? You just simply sit there and say, hey, I'm going to lease this property for so long. And in some cases, you will revert that property back to the lessor at the end. But in some cases, you're going to do what? You're going to end up with that property at the end. And we'll see that that's one of the criteria that will require us to count for this as a financing lease. Okay? So I just want to go ahead and go through the slides here with you for these leases from chapter 15. Okay, and you can see that we're going to be having a contractual agreement between the leasee and the lessor. The lessor owns the property, the leasee is the user of that property, and often the leasee will end up with this property at the end of the lease, and then we'll see that that's going to be accounted for as a financing type transaction. Okay. Now we come over and what are some of the advantages of leasing? And one of the big advantages is it's going to provide a tax advantage. Okay. Not that you need to know my personal business, but I lease all of my vehicles because when I get it after 3 years, I lease it because I can write that off against certain business transactions I have, etc. So my car payment, if you will, goes and was written off against my taxes. So one of the advantages there that they don't really mention here, maybe provides operational incentives. Incentives for me is I drive a new car every 3 years. So if there's any sort of changes or updates to technology or whatnot, I always get to take advantage of those. Okay, so these could all be different reasons for leasing rather than buying outright. Okay, now we come over and we talk about the leasee, the lessor. Okay, if it's a leasee and we meet certain criteria, we're going to call that a financing lease or finance lease. That is though we have purchased that property outright. Okay, if it's the lessor and we meet certain criteria where the leasee is accounted for as a finance lease, then the lessor will account for it as what we call sales type lease. Now, sometimes a sales type lease will not have a selling profit. So the only income they're trying to make off of this situation is just the financing portion. And we're going to see that their income, their revenue on this will simply be interest revenue. Other times the lessor will sell the property at more than their cost, and that will result in not only the financing profit but also the selling profit. So the sales type lease, you could have one profit, just the financing. You could have two profits, which is going to be both the financing and the gross profit from selling that item for more than its cost. Okay. If we don't meet the criteria for a financing lease, we are going to be dealing with operating lease. Operating lease is a piece of cake, guys. It is simply a rental agreement. Okay. All right. So we come over, and how do we know if we have a lease that needs to be accounted for as a finance lease by the leasee, sales type lease by the lessor, right? Okay. And we give you these criteria here, and we have there is an ownership transfer of the asset at the end of the lease agreement. Okay, so you can go ahead and you can put an O there if you want to try to remember these criteria, because you're going to have to know these. I'm going to try and give you a mnemonic to help you remember these. But if there's an ownership transfer at the end of the lease, we will treat it as a finance lease. Now think about it. The lease term says the asset will revert to the leasee at the end of the agreement. Well, that's like buying that asset, isn't it? And so they're going to make us account for that as though we're purchasing that. We're going to take depreciation, etc. Okay? There could be a bargain purchase option. Okay? And if it's a bargain purchase option, I would put a W in there, and that'll just help you to remember a written. That says written bargain purchase option. Okay, just say that it's written. Bargain purchase option, though, is the key term here, right? Now, if the lease term is for the major part of the remaining economic life, okay? So if it's for the major part of the lease term, and you can go ahead and put an L there, okay? Then we're going to go ahead and account for this as a finance lease. Okay? If the present value of the lease payments, okay? So you can put another L here for the lease payments. So we got the lease term, the lease payments, and if the present value equals or exceeds substantially all of the fair value of the underlying asset, then that will be accounted for as a capital lease. And then we have what? The underlying asset is of such a specialized nature. In other words, what? This item was produced almost specifically for the use of this leasee, then that will be considered a financing lease. So, I don't know. I thought maybe OWLL could be OWL, and what? Payments, special. And if you don't like that, you can come up with your own, okay? Or if you see one that you want to share with us right now, go ahead. But I'm thinking OWL special, OWL payment special. That's not obviously how you spell OWL, but that's how that would be pronounced. OWL special payments. But you need to know that what? If there's an ownership transfer, a what? Bargain purchase option, The what? The L stand for lease term and the lease payments. If the lease term is substantially all the life of the asset, then we're going to go ahead and account for this as a finance lease. And if the lease payments are what? Substantially all or more than the fair value of the asset, then we will go ahead and treat it as a capital lease. And then if it's a special type of underlying asset, which was almost developed exclusively for this leasee, then we account for that as a finance lease. Now you think about these terms and you think about what the was going on before. Entities were just treating all leases like a rent agreement, right? And FASB came in and said, well, look, we're going to look at certain criteria, and if you're in a situation where you're basically buying that, if you're going to have a transfer of ownership at the end, are you going to buy that? I mean, are you essentially buying that? Okay. If there's a bargain purchase, if you can purchase an asset for less than its fair value at the end of the lease term, the presumption on the part of the accounting standard setters is that you're going to exercise that option. If I tell you that you can buy this podium for me at the end of your lease agreement, and we've determined that the podium is going to have a fair value of $5,000 at the end of the lease agreement, and I tell you can buy it for $2,000, are you going to do it? Yeah, it's going to be worth $5,000. You buy it for $2,000, you could sell it and make $3,000, couldn't you? So if we have a bargain purchase where we're going to be able to purchase this for less than its fair value at the end of the lease, the assumption is that they're going to exercise that bargain purchase, and we'll treat that as though it's a sale, right? And then what? If the present value of the lease payments exceed or equal the fair value of the property, then what? You are essentially buying that property by paying for its fair value, right? Present value of the lease payments you're going to make equal or exceed the fair value. You're buying the thing, right? Okay. And then if it's of such a specialized nature that it's expected to have no alternative use to the lessor at the end, then what? They're making that especially for you, aren't they? And so we'll assume that you're buying that. Okay. Now, how many of these criteria do you have to meet? One. You meet any one of these criteria, we're going to treat it as a capital lease. We used to call it capital lease. We're going to treat it as a finance lease. And I may do that a number of times here today, call it a capital lease, because this has been a fairly new standard that FASB just issued that changed some of the old terminology. So I might slip into some of the old terminology from time to time, but I'll try to avoid doing that. I'll try to correct myself. But if I call it a capital lease, I mean a finance lease. Okay. Question? Okay, good. Only have to meet one of these criteria, right? Okay. Now we come over and we take a look at this example, and we say that on January 1st, Sans Serif Publishers leased equipment from First Lease Corporation. Okay, now let me ask you something first. Sans Serif, is that the leasee or the lessor? Lessor. Try again. That's the leasee. Okay, that's the person that's leasing the property, right? So that's the leasee. Okay, and then they're leasing the equipment from First Corp. That's what? That's the lessor, right? Okay, potentially the seller if we meet the criteria for a finance lease, right? Okay, so we got the leasee, we've got the lessor, guys, and we'll probably get into some of the homework today for Chapter 15, which is up on B courses at this point. If not, we'll do those next time. And what we're going to do is finish up Chapter 15 next time when we talk about sales type leases. That's an appendix, but I want to spend a little bit of time with you with that. And then we'll look at we'll finish looking at the homework if we haven't looked at it at that point, and we'll start deferred taxes on tomorrow, the slides for deferred taxes for Chapter 16. Forgot to say that at the beginning. Anyway, so we have the leasee, we have what? The lessor, right? Now we look at what the leasee had purchased the equipment from this company that produces computers or whatever it is, and that cost the lessor $479,079. So let's just make sure we're clear. The lessor did what? They purchased this from the manufacturer, didn't they? Okay, so they own this property, and then they turned around and did what? Decided to lease it to the leasee, and we're going to look to see if this should be categorized as an operating lease or a finance lease. If it meets any one of those four criteria: ownership transfer, bargain purchase, lease is what? Lease term is substantially all the life of the asset, or what? The lease payments represent more or equal to the present value. The present value of the lease payments are equal to more or equal to the fair value of the property, or what? It's a specialized type of equipment, which just doesn't sound like this is the case, because they did what? They purchased it from somebody else, so I doubt that when the lessor purchases it from a third party, that it's going to be exclusively to the specifications of the leasee. But anyway, let's go ahead and let's look at this, and we say that what? The lease agreement specifies 6 annual payments of $100,000 beginning January 1st, 2018 at the beginning of the lease. And I'm going to have to find a table. I'm going to have to do a search here. I'll probably pause the recording to find a table that I forgot to get. My colleagues started talking to me. I was going to get that. But anyway, and at each December 31st thereafter. Okay, so we're making the lease payments what? At the very beginning, aren't we? The day we get this piece of equipment, we also give a lease payment. Okay? And then they tell us that the 6-year lease term ends December 31st, 2023. Stop. Do we have a financing lease? How many payments? How long are we going to lease it? 6 years. What's the life of the asset? 6 years. Are we leasing it for substantially all of its life? 100%, right? Okay. Now, when you get into substantially all, it used to be, before they made the changes to the standard, that you had to get 75% of the life in order for it to be considered what they called a capital lease at that point in time. They've backed off of calling out a specific percentage, and now they just say what? Substantially all of the life, okay? And it gets a little bit hard because it's sort of up to the judgments in the eye of the beholder of what we mean is substantially all. I would say, though, you could use as a rule of thumb the old rule, which was what? 75%. You start creeping up 75% or more of the economic life, then we're probably talking to capital lease. And here we're at what? 100%, so it's a no-brainer, okay? I am not going to give you questions on the test in which you're going to be having to guess if it's substantially all. I'm going to stick with the what? That 75%, 80, 85%, 90% type thing, 100%. You're not going to have to sit there and see, geez, 60% enough? I'm not going to do that. I'm going to make it clear to you that you've met one of the criteria, but you need to know what the criteria are, right? Okay, which this one is the economic life that we've met, okay? And December 31st is equal to the estimated useful life of the equipment, 2023. Okay, so that's the useful life. The price serf pays for the right to control the use of the equipment is the present value of the lease payments. If funds were borrowed to buy the equipment, the interest rate would be 10%. Because remember, we're essentially doing what? Financing this thing. Okay, we're going to give this $100,000 first lease payment. It's almost like a down payment, isn't it? And then we're going to continue to pay on this thing over the next 6 years. Okay, so we say, how should this lease be classified? If we apply the 5 criteria, it is what? And we take a look at the next slide, and remember, oops, where was those yeses and nos? Okay. What the heck happened to my yes and no slide? Did I hide it? What the hell? Oh, I see. It's the one after that. Well, before we do that, let's just look at this slide. I probably should have done it in a different order. Okay, this is what I was looking for. We don't have what? An ownership transfer. So that's a no, right? Okay. We don't have a bargain purchase option. So that's a no. we did have that what? Economic life, okay? And then I see why they wanted to look at the other slide first. When we looked at the present value of the lease payments, they were equal to the fair value. I see why they wanted to do that other one first. So that's also a yes. And then what? There was no special use. But how many of these do we have to meet in order for it to be a capital lease? We just need to meet one, right? Okay. Now, let's go back and look at that present value of the lease payments, okay? And what they did was they went ahead and they looked at the $100,000 and they came up with the present value of the lease payments by multiplying it by the present value of an annuity due factor, and that annuity due factor was 4.79079. Now, what I wanted to do here.
Question.
Are
these the numbers we have on the? Is this the annuity table or is this?
It's the wrong one that you have. Okay, you have an ordinary annuity table, Art, which is Arthur, which is the payments being made at the end of the year. When we have the annuity due, the payments are made at the beginning of the year, and that's what I forgot to get for you, which I'm just going to Google right now. It should be easy enough to find. I'm going to Google annuity due table. Okay, let's click on that, see if we get the right one. Present value of annuity due. Okay, can you see that up there okay? Kind of, sort of. Okay, let me see if I click on this, if it'll give me the better image. Okay, there we go. That looks pretty good. Okay, so it's very similar to those tables that we were working with. The difference is you have to look at annuity due table when the payments are made what? At the beginning of the period. The ones that I gave you for the last exam, we dealt with ordinary annuity because the payments were made at the end of the period. Okay, so all you need to remember is what? If it's beginning of the period payments, we use annuity due. If it's end of the period payments, we use ordinary annuity, right? Okay. Now, question on that? Well, let's look at this one. What was the interest rate? 10%. It was what? Six periods. So 10%, 6 periods. Where are you at? 10%. Was it this one right here? I can't write on this one because I think this is the internet and I won't be able to write on this because I haven't downloaded it. But is it 4? Was it 4.7? Yeah, that was the number, right? Yes. Okay, so this is the annuity due. So that's where they got this those numbers from. Okay, now what I wanted to show you though was how to compare an annuity due to an ordinary annuity for comparison purposes. So if you take a look at this example, notice that what? For the ordinary annuity, the payments are being made, and let's just count the payments. Let's just circle right here and circle today. I don't know if you have this or not. You may have not downloaded the slides, but you'll see this on B courses. And if you take a look at this, what? The payments for the annuity due are coming out what? At the beginning of the period? Whereas the payments for what? For the annuity due are coming out at the beginning. For the annuity due are coming out at the beginning of the period. For the ordinary annuity, they're coming out at the end of the period. But notice the comparison that what? Payments 2 and 3 of the annuity due are the same as payments 1 and 2 for the ordinary annuity, aren't they? Okay, so you could actually use the ordinary annuity table to come up with the present value by simply doing what? Going to the ordinary annuity table and finding the discounting for what? 2 payments, and then you simply do what? Add in that first payment without discounting it because that payment's coming out what? Immediately today. There is no need to to the present value. So I'm just showing you the connection between ordinary annuity and annuity due, and you can literally use the ordinary annuity table to figure out the annuity due payments. Discount what? If it's 3 payments, 3 payments minus 1, right? If it's 10 payments minus 1, you'd go to what? 9 payment row for the interest rate. That would give you the discounting for the back 9 payments, and then you would just add in that first payment without discounting it at all, and that would you'd be able to use an ordinary annuity table to come up with the annuity due. Okay, so you go over and take a look at what we saw, and when we did the factor that we just looked up, we found that what? We found that the present value of the lease payments is going to be $100,000 a year for what? For 6 years, discounted at 10%. We found that the present value of those was $479,079, which was equal to what? The fair value of the property, because that's what the lessor had paid for it, right? Right? So it was equal to the fair value, the present value of the payments was equal to the fair value. So we met 2 of the criteria. We only had to meet 1. Okay? Now we come over and we say on January 1st, they purchased the property, lease agreement, and we have this $479,079. And since we have met the criteria for a finance lease, we're going to literally record this like an asset. But we don't call it right out equipment. We call it right of use asset. We're indicating that what? It's not our typical equipment, and that it's under a different agreement as opposed to just a straight purchase. We've acquired it under a lease. So we call it right to use asset. And we'll go ahead and we'll debit the right to use asset for the present value of the lease payments and credit lease payable. So if the company had met any one of those criteria, would they be able to hide this liability? They would not. They'd have to bring in this payable. And so the FASB required that because we do not want them to finance this thing off balance sheet by putting a legal fiction on it, calling it a lease when in fact it's a purchase, right? Okay, and it only needs to meet any one of those criteria. Ownership transfer at the end, bargain purchase, present value of the lease payments are greater than or equal to the fair market value of the property. The term of the lease is greater than or equal to the economic life of the property, or it's some sort of specialized type of equipment or whatever that was produced that the lessor wouldn't want the thing at the end, right? Okay, any one of those. Okay, now for the lessor, assuming that this was a sales type lease with just the financing profit, because they did sell it at their cost, didn't they? They sold it at their cost, and all they're trying to do is make money on the what? On the financing aspect of this, and then they would go ahead and debit the lease receivable for the present value of those lease payments and credit the equipment that they are now essentially selling to the leasee. Okay? Okay, good. When they purchased it, they had done what? They had debited the equipment, credited cash, whatever, right? And now they're just simply indicating that they have sold that. Or at least not sold. They've sold it because they're taking the equipment off. Okay? Okay, good. Now we come over and we make that first payment. And when we make the first payment, all of it goes towards principal, doesn't it? There's been no interest accrued at this point. There's no incurring, I should say, of interest, because the first payment was made immediately. It was made today, so there's no interest factor associated with that. So the entire payment goes towards for the leasee, the payable, for the lessor, the receivable, right? Okay. Okay, good. Now we come over. And now we have to start to figure out the interest associated with this. So when we go ahead and we make that second payment, we're going to calculate the interest on the remaining outstanding balance. So since the first payment went all towards principal of $100,000, and we initially had a payable of $479,079, we multiplied that by the 10%. So our interest portion of that second payment is going to be $37,908. Okay. The remainder goes towards what? Goes towards the principal, and of course we have to pay the $100,000 cash each payment, right? For the lessor, they are finally doing what? Making some money off of this deal in what? In the format of the interest revenue, right? So they really are a financing company more than anything, aren't they? Okay. Question? Okay, good. Now we go ahead and we give you this amortization table, and I guess to have these little arrows here, I'm going to have to go a little bit at a time. But the first payment did what? Went all the way towards principal. So there was that outstanding balance. We take the outstanding balance times the 10%. That's that 37,908 that went towards the interest. The balance goes towards principal, doesn't it? We subtract that balance off the previous balance. Here's the new carrying value, right? We bring that new carrying value over times 10%. That difference goes, that's my interest expense. The difference between that and 100,000 goes towards principal, etc., right? Okay, and by the end of that last $100,000 payment a little bit will go towards interest. The rest will do what? We'll wipe out the remaining balance on that thing so that it zeroes out. Question? Okay, this is how anything gets amortized. House payment, car payment, anything you deal with in life, this is how they're going to amortize it for you, right? When you make your payment, so much will go towards principal, so much will go towards interest.
Why don't the leasee just buy the equipment from the restaurant?
Because they don't have the cash.
But if it has a debit, or it's just like the amortization table when we talked about the bonds, right?
Uh-huh. Why didn't they just buy it like with a note or something?
Yes.
Because they don't want to end up with it, presumably. Okay, or they want to have it as it just works better for them if it's a lease agreement for tax purposes. So they want to lease it. So they have this, what we would call a legal fiction of a lease agreement, but the accounting standards are stepping in and saying, no, it's not a lease, it's a purchase, and here's how you treat it. And your instinct is right on in that you're saying, well, this is how you'd account for it if it's a purchase. That's right. That's the point of this. Okay, so for whatever reasons, legal, tax purposes, they want to drive a new car every 3 years, whatever motivates the individual to sit there and decide to lease something is fine. But if the lease terms meet certain criteria, then we're going to go ahead and account for it as a finance lease, and we're going to do it as though we're purchasing it. Okay. The bargain purchase option at the end, probably they'll exercise that, the ownership transfer at the end, okay, and that's probably, well, why wouldn't you buy it? Well, they were probably trying to, at one time, create a loophole for them not to treat it as a purchase, and so they would put that sort of deal in there. So, in effect, FASB was closing that loophole, saying, no, if that's the agreement, then you're buying it, okay? But acquiring it for most of its life or acquiring it for the present value of the lease payments are both things that could actually just happen just through the economic agreement of the lease there. And so if that happens, then they also make us treat it as a capital lease, even though we may have been trying to get through a loophole there. It's just the way it turned out. Okay? Question?
Is there a margin, or can I acquire it for $1 less than the present value of the payment?
They used to have the 90%. Was the threshold. The present value of minimum lease payments had to be at least 90% in order to have it be for capital lease. If it was less than 90%, you didn't have to treat it as a capital lease. Now they say substantially all. What does that mean? Could mean 100%, could mean 90, could mean 85, could mean 80. We start getting to 70%, more questionable. And so what they're doing in the standards, and this is US GAAP trying to get more in tune with the way IFRS does things, because IFRS says, hey, we're going to give you a principal, substantially all. You, company, know the nature of that agreement. You go and you decide if it should be treated as a finance lease. US GAAP for years has been, no, we're going to give you the rules, and we're going to tell you it's 90%. Now get over there and wait till it's 90% before you treat it as a operating lease. Finance lease. Now US GAAP is trying to be more like IFRS and say, well, substantially all. Okay. When you think about it, this 90% and substantially all, that's creating situations where what? Many lease agreements won't be treated as a finance lease because you have to be taking it for almost all of its life or almost buying it for the entire present value or have one of these weird transfer of the asset after a bargain purchase, right? So most leases won't even qualify as a operating lease, capital lease because what? Because of this sort of requirements that you're taking for the whole life.
Most leases are operating leases.
Well, no, I probably shouldn't say that. One of them will meet the criteria. You will have an operating lease when the term of the lease is essentially less than a year. Okay, so most leases actually would be capital leases. So I think I misled you a little bit there. Will be, finance leases. Okay, and I'll show you how that works with the operating leases here in a second. Okay, now you come over and what I was trying to say is that most leases here that are using this, most leases will not use this approach. We're going to see that we can still be treated as an operating lease when we don't meet as a finance lease when we don't meet all of those criteria, but we're going to have a little bit of a different approach as to how we treat it. Okay, so we'll see this. We'll see it. You know what? I'm misspeaking. Let me back up. Let me go back to my earlier statement. Most leases will not be finance leases. Most leases will be operating leases, and it's only in rare occasion that we will just treat it as a straight rental agreement. Okay, so just hold that thought, and I'll show you here in a couple seconds how that all works. Okay, all right. Now we come over and take a look at the amortization of right. Remember we purchased this thing for $479,079. Remember we debited the what? Right of use asset for right here, $479,079. This is the leasee. So the leasee is going to, and they call it amortization. They don't call it depreciation, but it's like depreciation, isn't it? Okay, because we're going to take that amount and we're going to divide it by what? We're going to divide it by the 6-year life, and that's going to give me amortization expense, and I'm going to credit the right of use like I'd be crediting equipment if I had debited equipment when I purchased the thing, right? Okay. Okay, now if I am doing the lessor situation and there's a selling profit, then I'm going to have to record a sale and a cost of goods sold initially, and then I'm going to do what? I'm still going to have the financing profit. I'm still going to have the interest revenue. So we're really going to have two revenue streams here, aren't we? Okay. So in this example now, they did what? They tell us that they purchased the equipment for how much? $300,000. They're still selling it for what? $479,079 because they told us the present value of the lease payments was $100,000. We looked up the factors. So they're selling it for more than their cost, aren't they? Do companies do that? Every day, right? Okay, so let's go ahead and let's take a look at what they do now. Notice they still set up the present value of the lease payments. They still now, instead of just taking it off at their cost and crediting the equipment at the cost when it cost them $479,079, now what? Now they're taking a sales revenue. They're going to debit the cost of goods sold for what they are selling that equipment for, and of course they're crediting the equipment because they're assuming it now that they're selling that equipment, right? So if we look at the gross profit on this, it's $479,000 minus the $300,000. There's $179,079 in profit on this sale, and of course, what? As we go over time, they will go ahead and take that interest revenue the way we saw for the what? For the sales type lease where they were selling it at their cost. So we got two revenue streams now, both the interest and the profit on sale, right? Okay. Okay, good. So when they make the first lease payment, same thing. That first payment all goes towards principal, and then they would continue on after that. I don't know why they show us the first lease payment. I think that it would be interesting to see that after that, the payments continue the same, don't they? Where some goes towards principal, some goes towards interest after that as they continue to make that interest revenue. The profit on the sale is all recognized in that first year sale, right? In the first year of the lease when they sold it. Okay. Okay, good. Now, operating leases. So all of those were financing leases. Operating leases, okay, a sale is not recorded by the lessor, and we're going to go ahead and we're going to take revenue on a straight line basis, and the lessee records the right of the use of asset and lease payable. Okay, so yes, most leases are going to be operating leases and that they won't meet those criteria, right? So one of those criteria. So we come over and we take a look here, and notice now what's changed is they are leasing it for 4 years instead of the full 6 years. So it starts to beg the question now, are we substantially all of the life? And if we take 4 and we divide that by 6, what do we get? Something like 60%? Huh? What's the percent? 66%? 67%? What is it? Yeah, something like that. Okay, I guess that's not substantially all the life. You know, I don't know what to tell you. I mean, it was easier when they just gave us a number 75, but we are clearly what? Under 75, aren't we? So you could almost use the old rule to sort of help you to determine whether it's substantially all the life. If it's not, then it's not a finance lease. It's going to be what? An operating lease here. Of course, assuming that there was no bargain purchase, there was no ownership transfer, and the present value of the lease payments are not greater than or equal to the substantially all of the fair market value of the property, right? Which for that one, you could probably use the old 90% rule. Again, guys, I'm not going to get sneaky. I don't like this idea that you have to sort of figure out if it's substantially all, and then we don't give you a hard and fast number to use. It's kind of hard to test you in a situation like that. So what I'm going to do is I'll just probably make it clear, you know, that this is not considered substantially all the life. I won't tell you that it's an operating or a capital lease, but I will give you the key words so that you know that it's not substantially all, or it's not, you know, substantially all the fair value, substantially all the life. Okay? Okay, but since that's the case now, and it's what? 4 payments, we go to the present value of which table? Annuity due, because the payments are being made at the beginning of the period, and we go for 4 periods now at 10%. That gives me the factor, and that's the present value of the lease payments now, right? Now we come over and we take a look, and we will debit the right of use asset for the present value, and we will credit the lease payable here for the amount. So far it looks like a capital lease, a financing lease, doesn't it? Okay, but we're going to do something a little different here that is going to make this, the accounting is going to be a little different since this is an operating lease. So we come over and notice we make that first lease payment, okay, which is $100,000 cash, okay, for the lease payable January 1st, 2018. I have no idea why this damn thing is saying second lease payment, because if it's all going towards principal, where I come from, that's the first lease payment, okay? But maybe they're living in another world, okay? I think they just made a mistake and they meant to say first lease payment, okay? Then what? Then we go ahead and we come to the second lease payment, which is what? $100,000 cash that we're paying out. And then what? Then we go ahead and we take interest expense for the first period, right? For that first year, $348,865. That was that present value that we set up for the payable. The first amount all went towards principal, so we financed $24,865 685 times the 10% gives me my interest expense. I debit the lease payable for the difference, and I credit cash for that second lease payment. So far you're saying, well, John, that sounds exactly like the finance lease so far, doesn't it? But when it is an operating lease, notice my amortization expense is not the whatever the present value was divided by the life of the asset. It is now simply the difference between the amortization expense is the difference between the total payment and the amount that is interest. That gives me a debit to my amortization expense of $75,131. Okay, guys, this is a mechanical process. This is a mechanical process so that the amount of expense that I'm going to end up reporting is going to be equal to what? The amount of the lease payment. And so the way I do that is by what? Taking the difference between the payment and the portion that is the what? That is the interest, and debiting my amortization expense for the difference between the payment and the amount that is interest. Therefore, if you look at the total expenses that I'm reporting what? Interest expense of 24, whatever it is, 869, plus amortization expense of 75,131. The total expense I'm reporting is what? 100,000, which is what I'm paying out in cash as my lease payments. So it's like I'm just simply doing what? Having a year-to-year, month-to-month rental of this property. I'm treating it as though it was an operating lease. It's just the way I'm going about doing it is such that what? That I am showing the lease payable on the balance sheet. Okay, what FASB is trying to accomplish is that we show that lease payable on the balance sheet, but then they want what? They want the expense to pretty much be smooth to whatever it is that the cash is that's coming out each period. The way they smooth that expense so that the amount of cash that's coming out each period is by simply doing what? Simply taking the difference between the payment and the interest and debiting that to this account called amortization expense. And then, of course, we credit the right of asset. Okay? Okay, now that's the kind of things that make accounting sometimes a little bit difficult, guys. This is a mechanical process. If you're saying, well, John, what's the theoretical justification for this? There is none. This is simply FASB trying to please. When FASB writes a standard, they have to think about who? They have to think about the preparers of the financial statements. They have to think about the users of the financial statements, don't they? And they kind of think about academicians, people that teach, but not too much. And so they're not thinking about us too much right now, okay? Because they're giving us what? Some funky thing that we just have to remember, okay? So they're not caring about you with this approach. What they're trying to do is balance the needs of the preparers, the needs of the users. What's happening? Users want to know about the liability, don't they? Preparers, though, want to say, hey, it's not fair that I haven't met the criteria as though I'm purchasing this. I'm really just what? Renting this property. Meanwhile, you're making me take what? An amount that's showing my expenses going, essentially high in the beginning and lower in the end, when really, for a lease agreement, it should be what? Pretty even over the entire term of the lease, right? And so FASB says, okay, to help you out then, if you don't meet those criteria for a finance lease, you won't have your impact on your income statement be like a financing agreement. We'll let the impact on your income statement be more like a what? Straight rental agreement. Meanwhile, though, we're going to still make you put the liability on the balance sheet. So they're sort of compromising, aren't they? And who are the victims? We are. We have to learn it this way. And I guess accountants are going to be beat about, on this, because we're going to have to figure out how to make this all work through the financials, right? Okay. Question? Okay, good. Now you come over and notice the total lease expense, as I said, is the sum of those two, the 100,000. Okay. So just to look at the amortization table here, guys, notice that what? We're sitting here and we are doing the same sort of amortization to decrease the liability the way we did before. Okay? But we are also doing what? We are also going to amortize that right of use asset is sort of a mirror image of this. Okay, the interest and decrease in the carrying value of the asset will go down as this amount comes down.
The interest expense and the amortization expense are security for tax purposes?
Tax purposes, I think the entire 100,000 is deductible for tax purposes. Okay, and I don't know how exactly that's reported on a tax return. I'm not a tax accountant, but I would imagine that both of those are going to be deductible for tax purposes. The whole lease agreement, right? That's probably the reason they set it up as a lease payment. So even if it's a capital lease, a finance lease, for tax purposes, you're going to just write off the lease payment as a tax expense. That's probably one of the major reasons they leased it. That's why I like to lease the car, because I can write the whole thing off of tax. If I'm just buying that thing and I'm making a car payment, I can't deduct any of it. If I am sitting there, of course, I have to be using the car for business purposes. Okay, but if you're using the car for business purposes, then you can what? You can write off that whole lease payment, right? So you're really paying your expense is what? Is net of tax. So your expense is really 1 minus the tax rate times that amount that you're paying. That becomes your expense. So if your tax rate was say 30% and you're paying 100,000, you're actually paying 70,000 because you're getting to shield $30,000 from taxes, right? Okay. So I would imagine in both cases the whole 100,000 is written off. And the reason I say I imagine, I'm not a tax accountant. Okay, and there's always some weird loophole in there about what you can and can't do with the taxes, and so I'm not up on all those little nuances. But I would think it's something of that nature that you can take the whole amount off. Okay. Question? Okay. Now we come over, and the third lease payment now is going to be the 348,685 minus that first one that all went to principal, minus the second payment of which only the amount over and above the interest went towards principal. That's times 10%, right? So there's our interest expense. There's the lease liability, and then to make the total expense come out to 100,000, we just simply plug in there the difference between the payment and the portion that is interest, and that's how we amortize that right of use asset and take that to expense. Again, the expense is going to be what? 100,000 that next year, right? Okay, and it'll just keep going like that. Okay, and it'll continue to be 100,000 for the entire term of that lease, right? Now, when you look at this, when you look at the two and you compare them, the finance lease is going to do what? Is going to have more expense at the beginning and less expense at the end, because we're counting as expense what? Our interest, aren't we? Okay. Whereas what? The operating lease is going to have a what? A flat, smooth expense period to period, right? Okay. And so it doesn't have more of a arced effect that you would have with the finance lease. Okay. So you can see the difference here where our total expense is going to be more in the beginning, right, than the operating approach, and what? Less at the end. But, by the time you get to the end of this thing, the lease is about over. So the impact in the financial statements is what? Is relatively short in terms of the higher expenses under the operating approach, whereas when we first get this thing, we're taking larger expenses under the finance lease approach. Both of them do what? Both of them show the full liability, though, don't they? For the financing portion. Okay, so sort of a balance sheet income statement trade-off going on here under the operating lease approach. Okay. Now, after recording these entries, the leasee will have two lease-related expenses, interest expense and amortization expense. However, they combine them into one line item, the $100,000 for the lease, right? Okay. If it's a finance lease, we're going to do what? We're going to go ahead and report interest expense and amortization separately on the income statement. Lessor has what? A single lease revenue account in the operating lease and reports a straight line amount of $100,000 each year in its income statement. Okay. Okay. Now, if you take a look at some of the points here under IFR, all leases are accounted for as what? Finance leases. Okay. Only lessors apply the classification criteria to distinguish between a finance and an operating lease. Okay. So if we're talking about the leasee will treat everything as a financing lease, and it's only the lessor that's going to have to decide if it is a capital lease or an operating lease. Okay, so that's the main thing. Okay, that's all I want on this for IFRS, that we know that what? Only lessors will account for differences between operating and finance. For the leasee, everything is a financing lease. Okay. And again, what do? We're going to have the financial statement impact is what? Income statement is going to be nice and smooth period to period, right? And we won't have to take those bigger expenses at the beginning, which is what I was already pointed out. Okay, now those discount rates that they gave us, okay, 10%, whatever, okay. There are times where the leasee will not know the lease that is implicit in the lease, and if that's the case, then the leasee should use their own incremental borrowing rate. Sometimes the interest rate will not be called out in the lease agreement. And if it's not called out in the lease agreement, the leasee has nothing left to do but do what? Look at what they could borrow funds for. That's called their incremental borrowing rate, and they would use that. So there'll be some questions where I'll tell you the rate that is implicit in the lease, but it is unknown to the leasee, and the leasee's incremental rate, and I'll tell you what the leasee's incremental rate is, then you would default to what? The leasee's incremental rate. Obviously, if they don't know the lessor's rate, they have to use their rate. Okay. Okay. Shortcut method. What happens here? If we are dealing with a very short lease, and this is where I was getting confused. I was calling these operating leases, but we see that what? If they don't meet those requirements, they're all operating leases, right? If they don't meet those requirements, they're operating leases. Then you have some that are of a very short duration. And if they're a very short duration, then we will treat the lease payments as expense. Very short duration means a year, and a lease of a year is almost not even a lease, right? It's just simply a rental agreement. And so if that's the case, then you treat the entire amount of the payment as interest expense. Okay, lease expense. So whatever you pay month to month each year, that's a piece of cake, isn't it? Take that whole amount as expense. Okay. Both U.S. GAAP and IFRS allow us to treat the entire amount as interest expense. As lease expense. However, U.S. GAAP defines the short term as 12 months or less. IFRS precludes a lease from being considered short term if the lease includes a purchase option, regardless of whether or not the entity is certain to exercise it. Okay, so if there's a bargain purchase option, U.S. GAAP looks to see if it is reasonably certain that they will exercise that. IFRS comes out and says, hey, we don't care if it's reasonably certain. If there is a bargain purchase option, you have to treat it as a you can't use the shortcut method. Okay. All right. Let's go ahead and stop there because I need to take a break, and we'll take about 10 minutes and come back and pick up some of the more nuanced points now that we've got some of the basics down about what happens to determine the lease is uncertain. Okay. Want to do, rather than sit here and wait to get to the homework questions after we go through all the slides, the quiz questions, let's just go ahead and look at some of the quiz questions that pertain to what we've already learned, okay, so we get a better chance to apply it here up front, and then we'll get back to the balance of the slides after we go through a few of these questions. Okay, this homework assignments for quizzes for chapter 15 is up on B courses, and I will be putting up some homework assignments today in Connect for you to look at as well. Okay, of course, if you don't have Connect, you still get the points for the homework as long as you're here in class, right? Okay, so we go ahead and we take a look and we say one of the 5 criteria for a finance lease specifies that the lease term be equal to or greater than major part of the economic life, right? It wasn't the entire economic life, wasn't meaningful part, wasn't a non-significant part, which would be ridiculous because that's sort of counterintuitive, right? The answer is the major part. Okay, one of the criteria for finance lease specifies that the present value of the lease payments be equal to or greater than substantially what? All of the fair value, right? And again, I'm not going to have you guessing by, giving you numbers to deal with. I'm just going to come out and tell you it's substantially all the fair value it's substantially the major part of the remaining economic life. Okay? Or I'll make it obvious because it's going to be 100%. Okay? All right, we come over and we take a look at number 3 for the leasee to account for a lease as a finance lease. The lease must meet, and it's what? Any of the 5 criteria specified by GAAP? It's any one, right? It's not all of them. Okay? For the lessor to account for lease as a sales type lease, the lease must meet, again, it's what? Any one. So it applies equally to the lessee and the lessor, those criteria. Okay, now let's take a look at this one, and we have this set of facts, and they're selling computer systems to Lone Star. So as I've said, the hard part for me sometimes these questions, I get down to the required and I can't remember who's the lessor and who's the lessee. Okay, so what I would recommend you do, if Technoid is selling the computers, that makes them what? The lessor, good. And if what? Lone Star is the leasee. Okay, so I always sort of put a little thing off to the side, who's the lessor, who's the leasee on these, because I get to the end, I'm like, who now? Who are they asking me about? I have to go back up in the question, and then I can't find where they said who's doing what. So, okay, so it's a lease, and it has the following situation: lease payments of $2,466,754 are paid semi-annually every 6 months. First payment is due January 1st, 2018. That's at the beginning of the lease, and the computers have a manufacturing cost of $12 million. Lease term is what? 5 years. No residual value. No purchase option. Economic life of the equipment is 5 years. So I'm looking at that, saying, well, I'm probably not qualifying to treat this as a finance lease based on the life anyway. Implicit rate is what? 5%. Fair value of the computers is $20 million. Okay, so I'm looking and I'm thinking this is probably going to be the situation where I'm going to account for it as a operating lease, right? Because I'm not seeing any of these criteria being met.
Yeah. The economic life of the equipment?
Economic life is 5 years. Oh, what's the term of the lease?
5 years.
Oh, it's 5 years. Oh, sorry, guys. I was looking at the 10 semi-annual payments. Thank you. 5 and 5. So I met one of the criteria. So it is a what? It is a finance lease. Okay, good. Sorry, I looked at the 10 instead of the 5. So we got 5. We've got what? We've got 5, right? Okay. Now we come over and they tell us, hello, that the what? Lessor would account for this as a sales type lease with a selling profit, and we know that it's a selling profit because what? The fair value of the computers have 20 million, and the manufacturer cost is what? 12 million. So they are selling it for a profit, aren't they? Okay, and presumably they're the ones that is manufacturing it. I don't know, or maybe they bought it for 12. I'm not sure, but anyway. Cost is 12 and the fair value is 20, so they're going to be selling it for for a profit. Okay, so it's a sales type lease with a profit. Now we come over and take a look, and Lone Star Company would account for this as a finance lease, right? That's the leasee. Coming down. What is the outstanding balance of the lease liability at June 30th? And round your answer to the nearest dollar. So it was semi-annual, right? First payment was made January 1st. Okay, so we're sitting there and we're saying, well, if we are having the present value at 20 million, that's the fair value. We're assuming that the present value of the lease payments are equaling the $20 million. We have what? We have this $2,466,754 went towards the principal. That was the first payment, right? Then we went ahead and we carried it for that first 6 months. Interest rate was 10%, divided by 2 is 5%. So 876,662 of that first payment went towards what? went towards interest, that means the remaining amount went towards what? Went towards the principal. So we go ahead and we take that 17,553, which was the carrying value at the start of the 6-month period, began June, after that first payment, began January 1st, after that first payment. And so we have a liability reduction of $1,590,092. So the liability is $15,943,154. That's because what? 1.5, 1.6 about of that first, of that second payment went towards the principal, right? Okay. Now we come over and we take a look at number 8, and what is the interest revenue that the lessor will take for, and they, you got to be careful with these because now they flip a little bit of a wrinkle in here for me, and they ask me what? All of 2018, right? Not just for the first 6 months, it's all 2018. So I have to combine what? I have to combine the interest for the revenue for the first 6 months plus the interest revenue for the second 6 months. So the first what? The first payment went all towards principal. So 20 million minus the first lease payment of 246,754 times what? Times the amount that was carrying for that first 6 months was going to be 5%. That gives me the interest for the first 6 months, 876,662, plus what? The interest for the second 6 months, which is going to be 20 million minus the first lease payment went all towards principal. And then what? Then I go ahead and I take off the amount of the second payment that went towards principal, which is the total payment minus the what? Interest portion. That would have been the carrying value for the second 6 months times the 5%. Gives me this 797,158. So if you add these two together, that gives me what? 1,673,820. Okay? And we'll see that we're going to carry on with some more questions like that in this quiz. You'll see some more of those. That you can start working on these questions today, and we'll finish these up tomorrow. And we're going to go through the rest of the slides today now. Question? Okay, good. Let's go ahead then. Did I turn this back on? No, yes I did. Yeah, I did. Okay. All right, let's go ahead then and let's take a look at some more of the slides. Okay, and what happens if the lease term is uncertain? Okay, in other words, let's say we're going to add some time to the lease after a certain period of time. We renew the lease. We're getting near the end and we add some more years to it. Well, all we're going to do is adjust our liability for whatever the additional time is on the lease and then just go and amortize from that point forward with the new carrying amount of the liability. Okay, so we come over and we take a look at this triggering event, which is essentially, extending the lease, or it could be termination of the lease, but we're going to look at example of extending the lease. Okay, so we have a lease had no significant economic incentive as of the beginning of year 6 to exercise a 2-year extension. By the end of the 3rd year, the leasee had made significant improvements to the asset. I don't know, maybe we were leasing a building and we went ahead and put in some lighting or something that we want in that building. Well, at that point, we think that lighting, say, has, another 3-year life on it or something. Well, we're not going to just want to walk away from the lease and leave this lighting that has value, right? So if you've done something like that where you've made a significant improvement that's going to motivate you to extend the lease, then we would go ahead and consider the option of extending the lease to be reasonably certain. So if the full term of the lease is now expected to be a total of 8 years with 5 years remaining, how would we go ahead and account for that at the end of the 3rd year? Okay. Now, if you look at this example, they tell us that the present value of the remaining 5 lease payments is $400,000, while the current balance of the lease liability before remeasurement was what? $250,000, right? So it's very simple. All we have to do is debit the right of asset 150 and increase the liability by this 150, right? Okay, so we're just bringing it up by the to whatever now the new present value of the remaining lease payments is, right? And then we would go forward and amortize that the way we've already seen. Okay, so when there are changes in lease terms, leases are required to assess the reclassification of the lease. So leases must apply the 5 criteria. So if that was the case and we changed at that point the lease terms over the triggering event, we'd have to determine now, should we account for this as a finance lease or an operating lease running back through the criteria after the terms have been modified. For example, if extending it, what was it, another 5 years, now took us to where we were taking substantially all of the life of that asset. Now, even though it may have been an operating lease before, it has to be accounted for as a finance lease at that point. Okay. Okay, good. Now you can also have uncertainties for certain contingencies such as asset usage, etc. Okay. So let's take a look at this. And so we say here in this example, certain leases provide for contingent events that are not measurable at inception. These contingent rents are primarily based on percentage of sales that are in excess of a predetermined level. Why would we do this? Let's say I'm going to lease a building to you and I want you to sign a 10-year lease. Is there some risk involved in that for either of us? 10-year lease that I ask you to sign? I'm going to lease you some property in Hayward for $500 a month. Is there any risk involved in that for me? What's the risk? Huh? Well, yeah, I mean, of course, yeah, I mean, there would be those sort of things. But let's say you got good credit and all that. Is there some economic risk, not credit risk, but some economic risk, some market risk associated with that?
If the price is good in 10 years, and for example, the real estate prices go up a lot.
Very good. Right? I mean, that's exactly it, right? All of a sudden, everybody realizes what a great place Hayward is, right? And they want to, rent property there or something. And I'm stuck with this funky $500, whatever we said, a month for the next 10 years. I'm thinking, geez, after a couple years, I could have rented this property for $1,000 a month. So what do? I may put a protection in there that says something like, hey, you're renting for a restaurant, building for a restaurant. And if your revenue exceeds, I don't know, 500,000. I want a piece of the action. So let's say your revenue is what? 600,000. Have you exceeded the 500,000? Have you exceeded the 500,000? And so I might sit there and say, you know what? I want 5% of that. So that means you owe me what? An extra $5,000? $5,000? Yeah. Now let's say that I've been charging you what? $500 a month. A month for 12 months is what? $6,000? So $6,000. So that particular year you owe me what? $11,000, don't you? You owe me $11,000 now? Okay. Now let's say the next year your revenue goes back down to, I don't know, $450. Now you just owe me what? Now you just owe me the straight $6,000, don't you? Okay, so we could go ahead and we would take whatever that sort of cushion for uncertainty, and it's treated as, for you, it would be an expense in the year that it happens, right? That extra $5,000, okay? And you don't have to take it, obviously, if you don't exceed the threshold, okay? So we come over and we take a look, and because the amounts of future lease payments are uncertain and often unavoidable, we don't consider them part of the lease payments. The lease payments were what? $6,000 a year, $500 a month, whatever, right? We don't consider that part of the lease payments. If I was asking you what the liability is, what the present value is, you would ignore this provision and just focus on what? The $6,000, right? Okay. And then what? If and when the lease payments increase, the change in the lease payment has no effect on the balance sheet account and simply is reported as a separate lease expense and a lease revenue, right? And so you would go ahead and your total expense would be $11,000. I guess what they're saying is you report them as two separate line items, but the total is what? The $11,000 in the period in which that happens. Okay. Okay, good. Two exceptions, okay, to not including variable payments if they are in substance fixed payments, or if the payments are based on the consumer price index. The reason being there that we can what? Reasonably estimate what the payments are going to be, okay, and so then we would go ahead and include them, okay. Otherwise, they are not going to be part of the payments that we would consider. Okay, we know what the CPI index is. If we come up with something that's going to increase the payments fixed over a period of time, then we would include it. Okay. Okay, good. Additional right of use. If that's the case, we consider the original lease terminated, and we will go ahead and now consider this extended use, and we consider this now being a new lease. Okay, modifying these terms sometimes will result in us doing what? Going from a finance lease to an operating lease, or from an operating lease to the finance lease, because now the terms are such that we're taking it over for the remaining useful life. The present value of the lease payments are, you know, substantial portion of the fair value, whatever. Okay, and so we come over. We come over and we take a look at this example. Okay, the additional right of use is like essentially extending the term, the period of the lease. So let's just go ahead and take a look. January 1st, 2018, the leasee leased this printing equipment from the lessor, who purchased the equipment for $479. Same facts, right? And they give us the information here. And then on January 1st, 2020, after 3 payments, the leasee and the lessor agreed to extend the lease term by 2 years and increase the remaining 3 payments from $130,000 to $130,000 each. So we essentially at this point have what? A new lease agreement, don't we? Okay, so we're going to have to figure out what the new lease agreement is going to give us here, and we have the original lease and what the present value was on January 1st, 2020, and then we have what? We have the additional payments here now for the modified lease is $329,068. So if you look, we have what? Increase this by $238,159. Okay, and so we go ahead and we have to modify this by increasing the liability by that amount. Okay, so we come over and the right of use gets increased, the lease payable gets increased by that amount, right? Yeah.
For the modified lease, 2 payments, only for the 2 last weeks, right, for 130.
Yeah, the 130, the lease payments agreed to extend the lease by 2 years and increase the remaining 3 payments from 100 to 130. Okay.
So the payments are still considered
Yes, the first three payments were considered to be 100,000, but we're trying to get the difference between the two. Okay, and so the present value at 2020, what it would have been, and then we have these the lease payments at 329,088, which is the remaining three payments here, right? Present value remaining three lease payments is where they came up with that 329,068. That's a little confusing because it puts it at 6 years with 139%. But when you calculate that 329, your question's right on. It's the three remaining payments, which they gave us in the footnote down here. Okay, and so that gives us that difference that we increase the fair value right of use and we increase the payable. And what they're telling us here at this point is this has now gone from a situation where we are now going to record this as a sales type lease for the lessor. So they'll increase the sales revenue. They're going to increase the lease receivable, and they're going to have to do what? They're now going to have to go ahead and sell this asset to us, right? Okay, and so what happens? Notice the cost of goods sold is going to be the cost minus whatever the accumulated depreciation had been, because they had been carrying that as equipment on their books all this time, right? Okay, and they're going to go ahead and, of course, credit the asset at cost now and debit the accumulated depreciation. Okay, so this qualified as a sales type lease at this point, and this is why this information was important, because it took us to where we are now acquiring the major portion of the life, and so they had to kick in treating it as a sales type lease. Okay. Okay, good. Guaranteed residual value. What happens here? If you lease me a Mercedes-Benz, is there a chance, I don't know if you guys like Mercedes-Benz or not, whatever, right? If you lease me a nice vehicle, is there a chance that I might beat the hell out of that thing? Right? I'm going to sit here and say, I leased this from Art, man. I'm going to go real fast over the speed bumps. You know that thing that says don't back up, severe tire damage? I'm just going to do it, right? Whatever, okay? So I'm, not treating this vehicle very well, and you realize that people will do that. So what you're going to do is you're going to put into this agreement that there's a guaranteed residual value. So I have to promise you that when I hand the vehicle back to you, whatever, it'll still be worth $30,000, whatever. Well, now what? Now I'm going to drive it very carefully. I don't want this thing to get all beat up, because when I turn it back to you for inspection, I want to say, well, wait a minute, you owe me this much cash because you beat the heck out of this thing, or you went way over the mileage, whatever it is, right? Okay, so that guaranteed residual value reduces your risk, and it's an incentive to me to take care of that asset properly, right? Okay, so how do we treat a guaranteed residual value? Well, it's going to affect the payments, because we're going to have to basically guarantee that you have that much money value at the end. And of course, the presumption here is what? That I'm turning the asset back to you at the end of this. So essentially, my present value is going to be less, because I'm doing what? I'm handing you back that vehicle at the end, right? You're getting something of value back. Okay, so I'm not purchasing the entire asset. So
Is this only for operating leases then?
no, it could be. It's relevant. It's only relevant to finance lease. Okay, if it was an operating lease, presumably, it'd be more like a deposit at that point that you might make me give you or something. Okay, this is only an operating. This is only for finance lease. Remember, we don't have to keep the asset for it to be a finance lease, right? It was simply that we're leasing it for the major part of its economic life, or the present value of the payments are equal to the fair value. In either of those scenarios, presumably I could be giving you that asset back, right? It's only with the asset transfers ownership at the end, then there isn't going to be any residual value, obviously, because I'm keeping it, right? And if there's a bargain purchase, we're going to look at that. We're going to assume that I'm going to hand you some more money at the end of this, right? And that's going to change it. So we'll see how the bargain purchase works in a second. Those are good questions, okay? All right, so let's go ahead and we say that what? Suppose a printing equipment, and it is expected that it will be worth $60,000 at the end of the 6-year term. Should this influence our calculation of our payments? And the answer is yes, okay? And here's why, and let's just go ahead and look at the example, okay, before we read all that justification. We have this, what, $60,000 residual value, and the estimated usability life of the equipment is 7 years. It's a 6-year lease. What, 6 divided by 7? More than 75%. So most of these problems we're going to see will kick us in to a finance lease, okay? And we have the 10% term, okay? Now the amount to be recovered is going to be whatever the fair value of this property is, and the present value of the residual value is 60,000 times this 0.56447. That's the what? Present value of a dollar, isn't it? Because the 60,000 payment is one-time payment, right? Okay, that comes at the end of this. And so the amount to be covered through the periodic rental payments is going to be what? And so we have the total amount that we're selling for minus what? Minus the present value of the guaranteed residual value, means that the payments are only going to cover 445,211, because that 60,000 is kicking out all at the end, isn't it? Okay, and so we have payments of 92,931. We got that factor from the present value of the annuity due table at what? 6 periods, 10%. It was 6 years was the term of the lease, and it was annual payments, right? Okay, now we come over and we take a look at the right of use, and it's going to be the 445,221, and we set up the liability for the 445,221. That's what? That's that number there, which is the total cost minus the present value of the guaranteed residual value, because we're not paying that until the end of this thing, right? Okay, and then we go ahead and we do what? We set up the entire amount as revenue to the as a receivable, I should say, because you are going to get what? You are going to, the lessor is going to get that money at the end, right? Because it's guaranteed residual value. Okay, so we go ahead and we set up the liability. There's a total amount. First amount is going to go towards my interest, and then I continue on with my payments. Each period, so much is going to be interest, so much is going to go towards the principal balance. And then notice when I get to the end here, that last payment is what? For the 60,000, which is simply going to be the interest on the residual value, and of course to decrease the balance. And so when I make that last payment, it pays that last interest, that entire, and the rest goes to decreasing the balance of the liability. Okay. Okay. And so when you look at the last payment here, what happens? We'll debit the equipment at this point because we're taking it over, and of course we have the interest revenue and the residual value of the equipment, which has come over, which is 60,000, the lease receivable, and the interest revenue. So we're essentially doing what? In that last payment, we're paying them off with the equipment, right? The last payment is actually a payment of equipment as they go ahead and they get the equipment worth 60,000. This is the lessor. Okay. Take a look at sales type lease with a selling profit now. And notice that what we're doing here is we're taking off of our cost of goods sold the present value of the guaranteed residual value, because that's coming back to us, isn't it? Okay, the equipment's coming back to us, and it's coming off of our sales revenue because that's coming back to us as well. So if it's a sales type lease, you take that present value of the residual value off of the sales revenue, off of the cost of goods sold. Okay. Okay. Now, effect of the residual value on lease classification and payments from the leases. Lease are the periodic lease payments plus any portion of the residual value the leasee has guaranteed. So if we're trying to figure out the present value of the payments, we'll consider that residual value that we're going to pay back, right? And then if the present value of the lease payments, including any lease guaranteed residual value, constitutes substantially all of the fair value, then it's a finance lease. So you do consider that as part of the payments to determine if the present value of the payments constitute substantially all of the fair value of the asset. Okay, purchase option. Okay, if we have a bargain purchase option, okay, then we're going to go ahead and include that if it is reasonably certain that we'll exercise the purchase option. From the standpoint of, economic theory here, if it's a bargain purchase option, then I'm going to exercise it. If I can buy it for less than the fair value of the asset at the end of the lease, then the assumption is that I will exercise that. And they call that a bargain purchase option. They say in practice, I don't know. In the biz, we call this a bargain purchase option, whatever. Okay? A BPO. So we come over and they tell us that we have this exercise price. They tell us residual value is $75,000. Would you take this deal? Would you buy it for $60,000? If you're determining that the residual value is going to be $75,000, then you would go ahead and you would purchase it for $60,000, wouldn't you? So we have an additional payment coming out. So what happens? To get the amount of payment, of course, we're going to back out that present value of the residual value, because that is a not residual value, but present value of the exercise price. Another mistake. It's what? Not residual value, but the exercise price, because we're assuming they're going to buy it for that, right? So they should have fixed that. I sent them an email. I said, well, what do you want me to do? Send you a daily, what are we going together now? I'm going to send you an email every day to say, here's another mistake. How are you today? I don't know what the heck they're expecting me to do. Just communicate. Should I call them each night? Just getting ready to go to bed. Wanted to let you know there were 12 more mistakes today. I don't know what the heck they want from me. Anyway, so there's that. Should have been what? Should have been the exercise price. You see the $60,000 there, right? And we take the present value. So all this is doing, guys, is showing us what? How much we have to cover by the payments, right? Because the residual value will come out at the end. So we get the payments. Payments are going to give us a present value of 445221. Plus now the present value, so we are purchasing this for $479,079, right? You're like, well, yeah, we knew that here at the beginning. Why did they make us do this? Because we got to figure out the payments, don't we? On this thing, right? And we've got two different streams of payments. We've got the annuity part. We've got the lump sum part. So we go ahead and we come up with that, and then when we go ahead and exercise the purchase option, there'll be what? There'd be that cash that comes out, and we would go ahead and have the remaining amount that is supposed to be paid, and of course there's a little interest on that last amount. And they would go ahead, debit cash, and do what? Take the lease receivable and take interest. This is assuming that they had sold this for their cost, right? Okay. And the amortization expense, okay, with the purchase option. Again, it's a finance lease because it's a purchase option, right? And so they're just telling us, since the term of the lease was 7 years, we go ahead and it's like depreciation, although we call it amortization. Okay.
Why is the amortization expense based on the full amount, not on the amount that doesn't have the actual expense?
Huh? This is over the entire 7 years of the asset. So it's going to be, it's the full 479, right?
Why isn't that the 445? The 479 minus, yeah, the right of use. Why don't we amortize the right of use and
Because we're not bringing that additional amount on until the end, when we bring on the equipment's residual value, but we're still depreciating that over the 7 years, right? Because that's the total what we're paying on this thing. So if we take the so if we take this 4511 plus the total that we're paying for this thing is 479079, right?
that's what we amortize.
Yeah, because we're essentially paying this for it.
That's assuming we're gonna exercise our.
Yeah, I think, you're making a good point here. Because if we debit the equipment, where did it go? If we debit the equipment for 60,000, right, when we get it back. Is that at the end of 6 years, though, I think, is the problem. Is that what it is? Wasn't there a debit to equipment here somewhere? That price is 65. Yeah, the missing thing here is that they didn't show that we would have debited the right of use for the total of these 479079, right? So you're assuming that they debited the right of use for 445221, right? Mm-hmm. But I don't think that's what they did. Did you see that anywhere? They would have debited right of use for 479079, right? And the liability for 479079. Because when they make that last payment of 60,000, that essentially gets rid of the remaining lease payments, right? They just didn't show you the amortization schedule here, but they would have debited right of use for 479. What's that number? 079. So they would have debited right of use for 479079 and credited the lease payable, right? For 479079, which is the sum of the periodic payments, present value, plus the present value of the bargain purchase amount, right? Okay. And so then using those payments each period, they would have gone ahead. They just don't show me the amortization schedule. They would have amortized it the way we saw before, where there was no bargain purchase at the end, and then the last payment is the bargain purchase amount, right? Okay, so when we make that last payment, that will liquidate this down to 0 at that point. So it's set up so that the last remaining payment, $60,000, will cover the interest between the previous payment and the bargain purchase amount that we're putting out, right?
Why is that 7 years in the amortization?
Because the asset's life was 7 years. Somewhere they told us, I'm trying to find it on the slide, but where did they say it was 7 years?
It says that it's 6 years.
Yeah, but the asset's life is 7 years, it says here somewhere. Oh, that part I can't.
Oh, yeah.
Huh? You say I thought it said somewhere here the asset's life was 7 years.
Yeah, it said that at the beginning, but why did we amortize only on the current year?
No, they should have used the life of the asset, and I can't tell you why they used 7 years. If it's a 6-year, I thought somewhere I saw 7 years. Wasn't there somewhere there was a 7-year
Yeah,
life?
it was 7 years at the beginning.
Where was it 7 years? I know I saw 7 years. Somewhere in here there was 7 years, and I didn't find it now. You know, I'd give like $50 to tell you that there was one in here where it was 7 years, right?
Yeah, it was, like, told that
Which slide?
made a useful life of like 50,000.
Which one?
Like 55.
The estimated useful life of the equipment is 7 years. Okay, I'm fine with that. I'm fine with using the 7 years based on this slide, right? But I can't tell you why on this slide they went ahead and made the 6-year equal to the estimated life of the copier. I think they were doing that to try to get us to realize that it's going to be a finance lease here. And meanwhile, they forgot that they had said 7 years. Okay? And then by the time they get over here, they're then using 7 years.
Why? Why?
Because they screwed up. Huh?
Because the lease term is 6 years.
But it doesn't matter. You'd use the life of the asset. Because you're ending up with that asset at the end, aren't you?
That's from the lease point of view?
No, from the leasee's point of view. Leasee is buying this asset. The leasee is buying this thing for $60,000 at the end, right? You know, they're going to pay this bargain purchase amount to buy it at the end for $60,000. And so they've got to depreciate it over 7 years because presumably they're going to get another year of use out of it, you know, after the lease is over, right? So all the financing is done on 6 years because that's the term of the lease. And then we have this equipment, and if we didn't depreciate over 7 years, so presumably there's 1 year left on this thing. We'll take that last year's depreciation. But I can't tell you, and it's pretty close. See how it's 68.44. There should be about what are we saying, 60,000 at the end. There's a difference there, which I think I'm not exactly sure why there's a difference, but it's a couple thousand, $8,000 difference. But We're presumably saying that we're going to have it for another year, for that seventh year. But if they told us it was 6 years is the life, then you're right. We should have depreciated over 6 years, amortized it over 6 years. Anyway, amortize it over the life of the asset, whatever it is. And we use this full amount because, again, this is not what we record as the asset. We record this as the asset, right? Okay. Okay. Ethical dilemma. I know we had discussed that the asset's supposed to be worth $24,000 when our purchase option becomes exercisable. Ferris insisted, that's why we agreed to the lease terms. But Jenkins, you know how in certain technology changes are, we can make a good case that they'll be worth $40,000 in 3 years. Okay? The computers to which Ferris referred were leased to a customer this week. The lease meets none of the criteria for classification as a sale-type lease, except that it would contain a bargain purchase option that is reasonably certain to be exercised, and the computers would be worth $24,000 after 3 years. Okay? And so they're calling this an ethical dilemma, and that what? If they set it for $40,000 after 3 years, then what? Then it's not reasonably certain that it's going to be exercised, and so we would not treat it as a sales type lease. But if it was reasonably certain, we would treat it as a sales type lease, so we could take that profit sooner, couldn't we? And so the question is, would you want to do this if you're the company? And they call it ethical dilemma. In the short run, your income is looking better because you're doing what? You're taking that profit on that sale early on in the first year when you sell it. But what's happening? You're hurting the company later on. I don't know why they're calling it an ethical dilemma. You're hurting the company later on, and that you're going to let this person buy something for 24 that potentially could be worth 40, right? So they're really putting short-term gains over the long-term, financial position of the company, right? Okay, by setting that price lower so that it qualifies for a sale-type lease. Okay, I don't know that a company would do this, but it's certainly something that, if somebody was a manager who had an incentive for a nice bonus, if they're going to get a bigger profit and they want that bonus sooner, so they go ahead and they want to take that profit this year so that they can get a bigger bonus this year, because they know that in a year from now they're going to get fired or something anyway, or they're going to quit. Okay, so that could be, I guess it's an ethical dilemma. Okay, termination penalties. Okay, whatever those are, they would have to be determined and included in the process if it was considered that they would actually have to terminate the lease early or something. Okay. Over here we give you some summary tables. Okay, we give you. I don't know if I want to be considered part of these guys, considering all the things they screw up. But this may not be a bad thing for you to review. Okay, I'm not going to go through all these. We've covered most of these. We've covered all these. Okay, non-lease components. What happens here? Maintenance, insurance, property taxes that have to be paid. Okay, and we're going to do what? We're going to expense those as we incur them, right? Okay, so if you take a look, they'll be expensed by the leasee, and we will do what? We will exclude these when we're coming up with our present value for our right of asset, for our liability, etc. We simply expense them at the time that we have to pay them. Okay, so here we have a $2,000 amount that is going to be a service maintenance agreement that's being done, And so the 6 annual payments are $102,000 beginning January 1st. So notice that what? The lease payable, when we make that first payment, the $100,000 goes against the lease payable. The $2,000 is maintenance expense, right? Because each period we have $2,000 that we pay as a maintenance fee. For the lessor, that's going to be a maintenance fee payable that they're going to have to cover because they're going to need to obviously provide that service now. Okay. Okay. Initial direct cost, or any cost that we have to pay to have gotten into this lease. For example, commission. If we're leasing a building, for example, we would have asked the real estate agent to find us this building that we can lease, right? So if we have to pay the real estate agent, that fee is considered part of the initial direct cost, okay, essential to secure the lease. So if that's the case, we're going to go ahead and do what? Include the sales type of lease that includes selling profit. And a sales type lease with no selling profit, the initial direct costs are deferred and expensed over the lease term. Okay. Leasehold improvements. What happens here? Let's say I have a building and I go ahead and I'm going to put lights up in the building. And I know that the lights have a 7-year life. Lights have a 7-year life, but the term of the lease is only 5 years. What's going to be my period of benefit? Lights have a 7-year life. Term of the lease is 5 years. What's going to be my period of benefit? 5 years is my period of benefit, isn't it? So I would amortize that leasehold improvement over what? 5 years, because presumably I'm going to be out of that lease even though the lights have 2 years left on them, right? Okay. What if the lights have a 7-year life and the term of the lease is 10 years? Now I'll use what? The life of the lights, the 7 years, because I'm going to use up all the benefit from those lights and still have 3 years to go on the lease, right? So the rule of thumb is what? To use the shorter over the term of the lease or the life of the asset. Okay? Question? All right, we're going to stop there. I'm not going to worry about statement of cash flow impact because we're going to get to statement of cash flows, and I am not going to talk to you about disclosures. Okay, if there are disclosure issues that I want you to know about, I'll put them in a quiz question. But I do want you to be aware that we are going to go through the sale leaseback arrangement next time, and then we're going to go through the quiz for chapter 15, and then we're going to start on chapter 16 next time. Okay? All right, guys. You know, I'm looking at that. I don't understand why what they did. It just doesn't make any sense. It's a 6-year is what they're saying here, but then they amortize it over 7 years.
Because you said we had to amortize over the lifetime of the...
Yeah, but they said 6 years here and 7. It's got to be another one of those screw-ups. Yeah.
That part shouldn't be there. Like, it's not
if it
equal to
just
the-
left it at 7 years, then this would make sense. Okay, and I think they lost themselves in the middle of this example and still wanted it to be 7 years. I don't know what to tell you.
Okay.
Okay, all right, thanks. Okay, great, thank you.
So you're gonna put the video up, right?
For yesterday,
Okay,
yeah.
okay. If I have
Yeah.
another question, I'll come to you tomorrow.
Okay, okay, sure.
Thank you.
All right.
Apologize for showing up so late.
It's okay.
I slept really late last night because I was prepping for a phone call.
Okay,
Yeah, so I just came as soon as I was back.
okay,
Yeah.
okay. I appreciate that.
Yeah. So
All right.
last
Did you
night-
sign in?
No, I didn't.
I had a little sign-in sheet, so just make sure you sign in. It'll be fine.
I wanted an update on my attendance and like my quiz scores. Like how is that looking?
You've been here, so I don't have you down as having missed any, so you should be able to get everything.
Okay. And on Friday, I'm going up to Orange County for exam.
Okay.
So I just wanted to let you know.
Okay. I won't take. We don't take attendance on the discussion aids.
Okay.
Okay.
Bye-bye.
All right. Okay. Bye bye. Have a good day. Let me just pause this real quick before we.
My pleasure.